The FHA was actually created in 1934, right after the banking crisis of the 1930s, with a goal of strengthening banking and mortgage loans, as well as to promote home ownership. And that was signed into law by FDR back in 1934. Now you fast forward to today, FHA comprises a big portion of home loans that are done throughout the United States. And some of the key highlights of the FHA loan are that they require a 3.5% down payment. The loan is guaranteed, or if you would, it's insured by the Federal Housing Administration. And let me explain what that means. Typically, banks want to see a 20% down payment whenever you purchase a home, because what it does is it protects the bank from sustaining large losses in the event that the homeowner stops making payments, and then the lender has to come in and take the home due to foreclosure. Because of the losses associated with that, they can run anywhere from 20 to 25% on average. A lot of banks are reluctant to do loans with less than 20% down. And so FHA steps in and says, okay, what we'd like to do is we would insure the mortgage against losses. So if somebody does an FHA loan, they stop making payments, and you have to take the home into foreclosure, FHA is going to step in and we're going to compensate the lender for a portion of the losses that they've taken on. And that's what they mean by FHA insuring the home loan. Now, FHA has to collect these funds from home buyers. And so what they do is they charge two different types of mortgage insurance premiums. The first one is called an upfront mortgage insurance premium, or UFMIP. And this can change, but currently in 2024, April 2024, it is 1.75% of the loan amount. Then they also charge an annual premium that's divided into monthly payments. And the annual premium is 0.55% of the loan amount if you're putting less than 5% down. If you put 5% down, then it's 0.50 or 0.5%. So the way you calculate that is you take the purchase price, you subtract 3.5%, then you're going to multiply that loan amount by 1.75, and that's the amount of the upfront. That upfront premium gets added to the loan amount because it's financed. FHA knows that you probably don't have money to pay that up front, so they just lump it on top of the loan amount. Now, the annual premium is something that you pay monthly, and that's included as part of your monthly payment. So your monthly payment will include principal, mortgage interest, property taxes, homeowners insurance, and the annual mortgage insurance premium. And depending on the property, you may have HOA dues. But that's how FHA protects the lender in this program, is through UFMIP and through the annual MI. So they only require 3.5% down. The loan is insured. FHA does not have limits on where the property can be located. Now, the property does have to meet FHA standards. And what that means is that it has minimum property requirements. It's got to be safe. It's got to meet all of the health standards. Depending where the property is located, it's got to have heat and air conditioning. You know, if you're in a colder climate, it may not be necessary to have air conditioning. It's whatever is typical for that area. All the utilities have to be working, or they have to be on during an inspection when an appraiser goes out. All of the appliances need to be working. Hot water needs to be working, right? The appraiser's going to go in and they're going to turn on the faucets to make sure there's hot water. They're going to turn on all the lights to make sure that electrical's working. And so the appraisal for an FHA is a little more robust than a conventional loan, because the government wants to make sure that the home buyer is buying a home that's safe, sound, and in operating condition. Now, it doesn't necessarily cosmetically have to be pretty, but it does have to be operational. So if you find yourself without a large down payment and you don't like the terms of a conventional loan, FHA may be a great loan program option for you with pretty good rates. The mortgage insurance premium is typically less than a conventional loan if you have a lower credit score. If you have a higher credit score, then you may want to look at conventional instead of FHA, because conventional loans require 5% down payment unless your income's at 80% or less than the median income in that area. Then they allow as little as 3%. So that'll be a different video going over the conventional loan program. I put that link down below. FHA, it's a great way to get into a house.